Good Monday. This is Kyle Kuster, Senior Analyst, and here with me today I have Jamie Sumner, our Chief Analyst. And we're going to be filling in for Jay right now, and it's a pleasure to be in front of the camera for once. And we're going to talk about some interest rate volatility and what's going on in the markets right now.
Yeah, this has been an exciting time here in banking, here in interest rates. And we're going to look back a little bit at what the FOMC put out there as their assumptions, their projections for the Fed funds rate at the end of this year, 2016. And you can see here they're up to about 1.4%. However, given the current state of everything, we could probably X this out. And we can see that for the most part when we go look at this chart.
This is a chart that's available through Bloomberg, and it's one of their templates, and I found it incredibly useful. And what we can see here is some historic, the lines here are the historic dot plots from the FOMC. And you can see our current dots, here, here, and here. But what you'll notice is that it's steadily been decreasing over time. You see the lines right now kind of dropping down. And more significantly here is you see this guy right here. And that is the option implied rates. That is what the actual market is telling us. They think rates are going to be around, what's that, around 50 to 75 basis points throughout the year. I mean, they're nowhere near where they're seeing 2016 at this 1.4, 1.5, and 2017 we're looking at 2.5. Options 2017 aren't even above 1.
That's right. So we can expect the next time the FOMC puts out this projection chart that the dots will be coming down a little bit in here. They're always a little more aggressive, but they should be coming down a little bit. And we could see this non-alignment within the market and the FOMC. If we look back, you can see the rate projections. This is from the CME group, who puts out the targets and the probability of increases. And we can see this is back in November 30th of 2015. So this is looking out, projecting out the probabilities for the Fed funds rate on November 2nd, 2016. We can see here, all the way back in November, the probabilities were a 30% probability at a 0.75 and a 29.7 probability at a 1%. So that puts it right about where the FOMC had it. But this is dated. We go to the current one just this morning, similar graph for the November 2nd meeting 2016, and we have here 71% probability of 50 basis points Fed fund rate. So not changing at all. Overall, there's a 28% probability of an increase in the Fed funds rate by this time. So we're really pulling back here, assuming the rates are going to stay where they are for the most part of this year.
So this is always a good chart to as a leading indicator of either maybe some rough economic times, as we can see the spread between the 3-month and the 10-year. Right before the recession, we had an inverted yield curve. So that's typically a big no-no. We're nowhere near there right now, but as of recent, you're looking at short-term rates going up, attributable to the Fed raising rates. And recently, we saw the 10-year drop to significant low levels, around a 1.6. So to Jamie's point previously, is if we're talking about a Fed funds rate that is going to go up another 50 basis points, this spread's going to come down as a result of that. Now, the Fed does have some room to work, but once we're starting to get down here again, it's some serious leading indication of a recessionary period. I don't like using the R word yet, but it could be troublesome. Definitely something to keep an eye on.
Yes, and it's very important, this spread aspect, like Kyle said, if that Fed funds rate, if the FOMC were to be very aggressive and start tightening and they raise that up, that's going to impact that short end of the curve, where the long end of the curve is still going to be suppressed because people are flight to quality, reducing down our treasuries.
But But what about the other option, of course, is if longer-term rates go down,
Yes.
do we go into that negative territory?
That's a scary assumption. We've been there before, and it tends to happen before a recession. So let's just hope we don't get to that point. But for next week, what we want to do is look out throughout this week. And these are a couple of indicators you want to look at that's coming out this week. We have the existing home sales and a new home sales. That's a part of the industry or the part of the market that really hasn't come back yet, but we're starting to make strides. The durable good orders, a very important number coming out as an anticipation of what's going to happen to our GDP in this first quarter of 2016. We have the FHFA quarterly price index that's coming out, home price index. And then we have the second estimate of the fourth quarter GDP. And if you remember, the fourth quarter GDP, that advanced estimate was fairly low. Wasn't negative, but it was pretty low. The second estimate's coming out. We're hoping it'll pick up a little bit around that 1%.
All right, so that's all we have for you this week, and both of us will be back next week for more on many of these economic indicators.
All right, have a great week.
Thank you.